Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling. With regard to Chen's newsletter, you do need to put your name on a waiting list, so go to miningstocks.com, put your name on a waiting list to sign up for Chen's letter, and that will be available only during the first couple of weeks of the new calendar quarter. You can sign up for my newsletter at any time at miningstocks.com. I want to thank each of you for listening to this show, and I would like to encourage you to keep sending along your questions, comments, criticisms, praises, what have you. Send it to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. We also want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Novo Resources, Dynacore Gold Mines, and Copper Bank Resources Corp. And we will be talking to the CEO of Copper Bank Resources in a little while, in fact, in about 12 or 15 minutes or so from now. I've titled today's show, Can America Continue to Dominate Asia in Quest of a New World Order? And Gianni Kovacek, he's the CEO of Copper Bank Resources. He'll be with me for the first time, as I said, in just a couple of minutes, and we are really pleased to have Michael Oliver with me once again to get his latest views on the precious metals markets on a day in which the gold price was hit very, very hard, I don't know, $35 or so on the downside, and so we want to get his view on what's happening in gold and some of the other major markets that we follow. Gianni will be with me, as I say, in just a couple of minutes. After our first commercial break, he'll be with me. We're going to talk about his very unique way to hold an option on copper. Well, that's at a time when almost nobody wants copper, but you know the old saying, buy them when no one else wants them. Well, that's what Gianni is seeking to do. He's looking to buy copper projects that he believes, not only he believes, but past work has revealed considerable value. However, unless you can get something out of the ground at a profit, that doesn't really hold too much value. So the idea that Gianni has, I believe, and we'll question him more about it, is that once you start to see copper prices rising above that break-even point, then you can make a lot of money once those options go in the money, so to speak. It's like buying a call option on copper is what he's trying to do, and he's providing a way for you to do that through his public vehicle, Copper Bank. Then at about 1:30, Stephen Harner will be with me. He'll be here for a second time on today's show. Stephen is the president of Yangtze Century Limited in Shanghai, and as a principal with 30 years of experience, Stephen provides real investment advisory and management consulting services, a lot of great insights into the geopolitics and economics of Japan and China and elsewhere in Asia. And there are some really interesting things taking place these days with respect to China and U.S.-Chinese relations, not to mention Chinese and Russian relations. So we're going to want to talk to Stephen about some of those issues as well. And as I just mentioned, Michael Oliver is also with me right now to help us get a sense of what's going on in the gold markets and other markets that we hold as being very important. Thanks for joining me again, Michael.
I'm glad to be here, Jake.
Really good to talk to you always. What do you make of this bombing on today's gold market? I mean, it's just almost like a waterfalls event, it seems.
Well, it's been several weeks of downside. A fairly even pace with a bad day here and a bad day there, and today's another, quote, bad day. The pullback, first off, in the context, the bigger context, gold went through a bottoming process, in my view, in mid-2013 through most of 2014, the lower end being 1180 price level. Mm-hmm. But then in November of 2014, it bombed out that low, went to 1140, which is like a couple percent below the old lows, said boo, and immediately turned back up. Yeah. So it turned out that, quote, breakout below the obvious 1180 low was, in my view, probably a bear trap. And therefore probably the bottom of the market. Subsequent to the November low, between then and January, gold went through layer after layer of things that I thought would signal upside. And when it crossed each layer, it would get a burst, $50 here, $80 there. Finally got up to 1308, I think was the high price about 3-4 weeks ago. We're now back down to 1203 today. I think it's about 1208 last I saw. Now, I'm looking at most of my momentum work and trying to discern where support is on this pullback, and I think it is right about here. beginning at about 1203, which is the 3-month average, coincidentally, on down to about the very upper 1190s. That's a zone where I would be very observant for a turn or a level that needs to hold, probably. The overall context of whether gold is now a bull or not has not been established. I think I'd call it 60-70% of the evidence, I think, came in from that November low through the January high on the positive side. But the one remaining hurdle or breakout level was that level at 1300. I wanted to see a weekly close above there, not just a poking out above there, but a solid close. I've got various reasons for that, price-based and especially momentum-based. So that's the final hurdle. Now, we've now had a $100 pullback from that hurdle. The question is whether we're failing or is this just a pullback before you ram that barrier one more time. And I think we have to watch it. I think these lows here are important. If we get a turn now, I would say even back up into the 1220s, probably you're safe. It's probable that the low has occurred in this secondary pullback. So it's something that has to be watched. You don't ever have a cocky attitude that you know you got the bottom in.
No.
It's always in layers that you establish those pieces of evidence.
Little by little. Well, tell me, Michael, do you have a time idea? Do you have a time parameter on this? Do we need to see gold reaching above 1,300 over a certain period of time?
I would say that if it's going to happen in a dynamic situation, in which gold is still moving dynamically within its base over the last 2 years and also since the November low, that if it's going to occur, it should occur by the second quarter, probably early in the second quarter. Otherwise, if you stall too long, even assuming you don't go back to the lows and you just stall, that's not a real good sign. You need to keep the dynamics, the fisticuffs need to keep going on. And I think that would be a positive thing. So I don't view the sell-off as negative. It is down toward what I think is support, but I need to see some modicum of evidence that it's turning up from this support. And I think a pop back over 1220 right now in the next day or week or so would be evidence of that.
I don't know if you're prepared to talk about silver, but are you? How does silver look to you? Any better? Any worse?
It should outperform gold if we turn up in gold fully. If gold actually crosses the 1,300 hurdle, I'm about 80-90% convinced that the better place to be this time around will be gold mining stocks, silver mining stocks, and silver, not gold itself. But I use gold as my, it's the big daddy, and so what he does sets the tone and the direction. But that doesn't mean he's going to be the leader on a percentage basis.
Right.
And this time around, I do think you use gold as your measure, and just assume silver will follow and lead at some point. In fact, a week or so ago, silver had quite nice up week. I think it was about $0.50 when gold had a flat week. There was a bit of a shift there. But again, we're in a flux situation. I think it's a bottom in gold, but I need that bit more evidence. I need to see support around here and an upturn, and then quickly get back over 1,300 in the ensuing weeks or few months.
Wow. Well, I'd say it's good to hear you as one who has a vested interest in gold mining shares. It's good to hear you a bit more bullish even on the shares than on gold itself. But switching gears a little bit, Michael, if we could, what are you seeing in the equity markets, the S&P 500, for example?
Well, it's very interesting. I use point and figure charts sometimes in my work, but I plot momentum in point and figure format. And if your readers aren't familiar with that, listeners aren't familiar, go online and look it up, and you'll see what I mean. It's X's and O's to plot the structure, the up and down in price or in momentum. And the action we're getting in the S&P right now on a price basis, as you know, I'm negative for momentum reasons, but just on a price basis, is virtually identical, upside down though, of the way the market bottomed in 2011. Remember in 2011 we dropped from the Bin Laden high at 1370 on the S&P, dropped quickly in August, most of it was in August, down to just above 1100. So almost a mini crash. August through September, 2 months, was volatile sideways action, where each side was a winner every other week. But it didn't go anywhere. It was just up, down, up, down, up, down, very violent. Well, that's exactly what the S&P has done since, September-October period, after the October low. Once we made that low and turned up, the action turned violent and mostly sideways. And we had, this is particularly true on the NASDAQ 100. You can see it jumps off the page if you look at a price chart of it. Well, now you've come up and taken out the high. Well, back in October of 2011, there was a flat floor between the August and the September lows, just above 1100. In early October, they drove it down to about 1070. So they took out the lows in a decisive manner. And on a point-and-figure basis, it was a multiple bottom breakout where it looked like, oh, golly, this congestion zone is resolving to the downside. Mm-hmm. Well, you can flip that over now. We're doing exactly the same thing in reverse. By reaching 2100 today, you've taken out the prior highs to the left, and it looks like a breakout. So in my weekend report, I caution readers, watch the price action. Mm-hmm. Because if you abort back down into the prior range, and I would say, for example, a daily close at any time in the future at 2060 or lower in the S&P is a signal that the, quote, breakout that we're seeing here is stillborn and is aborting.
Wow.
And that is a negative event in and of itself.
Wow. Well, nobody said it would be easy in these markets, Michael, and there it's a great example of the bear, if that's what we're turning into, the bear trying to get as many victims into his den as he possibly can, right?
Absolutely, yes. I had a old friend, a Chicago Merck trader, who said one of his favorite sayings was, no market ever made a top looking bad.
Yeah. Yeah. One more thing I'd like to ask you about before we have to conclude our discussion today, and that has to do with the risk-on, risk-off trade, and in particular as it pertains to the bonds of the debt markets. What are you seeing there?
Well, I'm seeing something unusual. For the last year, we've seen the low risk, low yield beat handily the high yield, such that high yield yields went up, not a lot, but up, and the low yields went down, prices went up. So things like the TLT or the 30-year bond or the 10-year note advanced nicely with yields dropping, while the high yield market was in trouble. Mm-hmm. I'm not so focused on the spread right now as I am actually on the German Bund, which is their 10-year instrument, and our T-note, which is a 10-year instrument. I watch the futures in both. And they're doing something that is it got me all itchy. I can't quite explain why, but they look like they're topping. Mm-hmm. And I've got some short-term indicators that say you drop a little bit more this week, and they're topping on a short-term or trading basis. But the problem is that the proximity of where we are now to some numbers that would break them on a longer-term basis is not that far. So if they stumble, they could fall. Now, what that implies is there's a potential spike in rates. And I don't mean high yield. I'm talking the safe stuff. The question is why? What eventuality, what set of circumstances could explain this? Mm-hmm. And one can speculate, and that's not what I do. I measure. I'm a technician. But I am seeing that shaping up out there, and that is an event that, if it occurs, will ambush a lot of people, because I don't think anybody's eyes are focused on the potential for the safe 10-year debt, U.S. and German, which is considered, the safest in the world. You don't get a yield, but it isn't going to hurt you. Mm-hmm. I see the potential for it to hurt you.
Wow.
And therefore I'm measuring, and if I get the signals, I will announce it. But it's looking like it wants to go that way. And again, that will be an upsetting factor for other markets, I'm sure.
Oh, my goodness, would it ever be? And, I don't know how many times good friends of mine and myself, too, have thought, goodness, this is the end of the bull market in U.S. Treasuries, only to find rates go to historical lows and just keep going lower and lower. As more money was printed and created, it created the buying, obviously, for those debt instruments when the risk was on. And it is fascinating, Michael. What you're telling us here, I'm sure there's not too many people seeing what you're seeing, so it's going to be fascinating to see how this plays out. I'll really be looking forward to it. And I would tell my listeners, if you want to keep up with what Michael's doing, especially accredited investors, I would really urge you to check out Michael's work. It's OliverMSA.com. Oliver, M as in Mary, S as in Sam, A as in Albert. OliverMSA.com. Check out Michael's work, because I'm finding it to be very, very, not only is it interesting, Michael provides a lot of color, along with technicals. And, a lot of technical analysts are sort of boring. Michael, I find, provides some interesting verbiage to go along with it. Thanks again, Michael, for passing that along to our listeners today. It's really fascinating stuff. What I do appreciate about technical analysis, and I'm not a technical analyst, but the idea is removing the emotions and remaining objective, letting the markets speak, let the markets do the talking rather than trying to figure it out yourself, right? Isn't it the collective wisdom of markets that you're trying to discern from the patterns you see, Michael?
That's correct, yes.
Yeah.
I do a lot of the work and instead of price analysis, which is the normal version of what you think of as technical analysis, I detrend price and analyze the momentum of price. That's my primary arena. And usually momentum will shift before price does, and therefore to the extent that I can call something, usually it'll call it before price makes it clear. And that's purpose.
Yeah, exactly. Well, thank you so much, Michael. We're out of time, but I look forward to doing it again, hopefully next week if you're available. Thank you so much.
I am. Thank you, Jay. Bye.